Welcome back, everybody. Tom O'Brien, Dow positive 220 points, NASDAQ positive 21, S&P's positive by 18. So it's Wednesday. Wednesdays, we have our crude oil numbers, right? EIAs come out every Wednesday, 10:30 a.m. Eastern Time. We'll get those inventory numbers just about 11 minutes from right now. So I have the crude oil chart up here currently. We're looking at the March contract, currently trading 63.75. So what we try and take a look at here, right? Let's jump around this a little bit to see what kind of volatility trades. Speaking of volatility, the topic of the week for sure. But volatility has to do more with just the S&P, which is what that VIX trades off. You know, you have volatility that's priced into any market. So let's see how the volatility trade shakes out on oil with this type of action. And we've seen some action in oil already this morning. Overnight session, about 9 o'clock last night, Eastern Time, we're up above $64. We come down at about 7 a.m. to below $63, and from there we're up almost a full dollar, 63.75. So first thing I'm going to do is jump over to the spreads, and let's take a look at the 11 a.m.s. So the numbers come out at 10:30. We have spreads that expire at 11 a.m., and these are going to give us an option, if we wanted to have 63.25 would be a price point we could use, or 64. Okay, 64 going to be the closer one to where it's currently trading. If you had a spread going from 64 to 65.50, and then you could have your spread going from 64 to the bearish side, down $1.50 to 62.50. Now this spread, because the market is currently at 63.73, you're going to have some bearish value here, because the negative spread, the one that goes $1.50 below 64, is the one that's going to have 27 cents of value in there. So this might be a little expensive as compared with when we pull this up sometimes and it's kind of right at the point. Like, for instance, if oil was trading right now at 64, but just to see what kind of price you could have, you would be selling the bearish one, which goes from 64 to 62.50, and that's why. That's going to cost you $41, which is more expensive than we usually pull it up when it's right at kind of that pivot point of 64, because within that price, you're paying for a solid 30 cents of intrinsic value, whereas the bullish one is only going to cost you $12 because you're basically 30 cents out of the money before you start getting any value, right? Let's jump over to the 12 o'clocks, see what kind of price they give us. Now, this is why we jump around, okay? So you jump over to the 12 o'clocks and look where these line up. So right now, and as we talk, oil's moving pretty quickly to the downside. We're now down about 10 pennies since we started this comparison. But the 12 o'clock spreads have a price point of 63.75, much closer to where oil is currently trading at, okay? So when we looked at the 11 o'clocks, right, we were dealing with about $41 on one side, 12 on the other. You're dealing with about $52 on both sides. But if you take a look at these, so similar spread in that you have $1.50 of movement to the upside from 63.75 up to 65.25, and you're going to have that similar $1.50 movement to the downside from 63.75 to 62.25, and again, you're going to have some value in the bearish trade, because right now it's 10 pennies below 63.75. The indicative, well, I'll call it 7 pennies. So you'd be selling the bearish position. It's costing you 37, and buying the bullish position costing you 30. So if for the people out there that have watched this before or traded this before, there is more premium priced in this product than there usually is, right? Are you checking this out, Tom? I mean, we're looking...
And you know what has happened too, Tom, is that it seems that it's in all the products, so the volatility is kind of across all these different...
And that would make sense. I mean, you've seen gold rocking and rolling, of course, you know, commodity-wise, as the market's, you know, kind of inversely to the market, gold. But, I mean, even oil, if it's not correlated to the market, oil, its own market, has seen some dramatic volatility. I mean, you know, we saw a dollar down and a dollar up just in the span of the last 12, 13 hours. So investors across the board are demanding premium, as they probably should in a market that has this type of volatility over the last 2 or 3 days. Now, with that said, though, you might get that type of a move. You know, it might be worth it to pay that premium, depending on what you think your market bias is. So, again, you know, this would be your bullish position, which would be out of the money. Right now, we're at 63.60. You don't get any value until you get it to 63.75. And from there, it would be costing you about 26, and the negative one costing you about 41. So $65, which would mean that you need 65 cents of movement away from that 63.75 point where both of these spreads start at for you to reach break even. And you have $1.50 potential if you just add each one. Now let's just jump around for the final comparison as we come in. Let's see where the dailies, because that was our 12 o'clock. And let's just see where so for 2:30, we're going to have either $63, could be 1 point we could use. Now those would be $3 spreads as opposed to $1.50. And then for the full daily ones, which I believe are $5, yes, so that's $5, they're going to start at 64. So in either case, you'd be about 40 cents away from the price. You know, they're going to be relatively expensive. Just to put it in context, let's pull it up and see the example. This would be your bullish position, starting at 64 to 69. This would be your bearish position, starting at 64 down to 59. You'd have $5 on each side. You'd be buying the bullish one, and you'd be selling the bearish one. Yeah, and it costs you about $80. And again, this is because the bullish one is about 40 cents out of the money, and you're still going to have to pay 20 cents for it, whereas the bearish one has your 40 cents of value, and you're paying that same 20 cents, so 80 cents or $80 for that price. So volatility across the board. You know, it doesn't mean it's not a profitable trade, but you just want to be aware of that type of premium that you'd be paying and see where it goes. So, you know.
And, you know, last night, Tom, when the EIA came out, right?
The API, right?
API came out, yes. It wasn't so much about the crude barrels. The distilled market was a plus 4.1 million barrels. It was like, wow. And that's heating oil. That's heating oil and jet fuel. You know?
And there's always, you know, we're going to get the top line number, which will be the crude oil surplus or, you know, decline. But, yeah, there's a lot of numbers that do come out at 10:30 with whether it's distillates, gas, and then they talk about demand as well, which is a factor that kind of plays into this market. So we'll see. But, you know, as, you know, since we've been talking, we started, it was at about 63.75. We're already down about 17 pennies as we come into these earnings. So you can see that, you know, when you're only looking for maybe 40 cents of movement for the 11 a.m.s, you're looking for about 60 cents of movement for the 12s, giving you an hour and a half. This market is jumping around. We're now at almost 20 cents of movement even before the news comes out. So it's probably priced pretty fairly, right? I mean, that's the type of moves we've been getting. Crude's been jumping around a lot. I mean, just going back to yesterday, there's your API number on the chart. I'm showing it. So last night, crude was trading at about 63.40. You saw the API number come out. It spikes initially within about a few minutes, up 43 cents up to 63.83. Continues upward all the way to about 64.17 at about 9 o'clock last night. And from there, kind of the cascade begins. And then at 7 o'clock in the morning, things turn around abruptly, and it jets up a full $1 from there. And then we've turned around once again. So there you go.
Big time.
Big time.
Yeah, I mean, and you know, when we look at these markets, what is intriguing is that if you look at ExxonMobil, you know, Exxon and the large oil companies, they started the downdraft in 2014, and though Exxon itself has just got smoked. I mean, it went from 89 bucks down to 78. So we'll see on a basis. It looks to me that oil more than likely is topping out right now.
We'll be right back, folks, in 3 minutes, and we'll have those EIA numbers. Come on back. Okay, folks, welcome back. Tommy O'Brien and Tom O'Brien. So I see that headline number on your screen, Tom. Crude oil inventories rising 1.9 million barrels. Gas inventories rising 3.4 million barrels. And we'll jump back to the NADEX platform and take a look. So market, we were at about 63.75, approaching 63.60 right before the news. And from there, we're spiking lower, 63.14 currently. So to put things,
nice move.
Yeah, to put things in perspective, right? No matter what trade we were looking at, the 11 a.m.s, the 12 o'clocks. The 12 o'clocks are the ones that lined up the nicest in terms of being closest to the point 63.75, and those we're going to need about 55 to 60 cents of movement. So call it maybe 63.15 to the downside becomes our break even, and that's kind of just the move we got. Now you can always trade out of the bearish one, look for a bounce, and keep your positive trade open, or you can hold on to it and then look for a bigger move. But it seems like we said prior to the market that things seem to be priced relatively fairly. And that first move kind of Proves that. We'll see. I'm curious. We'll have to pull up what the expectation was because, of course, everything is expectations. But either way, the market reacting and a quick dive, 50 cents to the downside. Okay, so there we go. The median estimate was 3.1 million barrels. We saw about 1.9. Cushing crude saw a decline of 711,000. PADD 3 crude, increase of 4.8 million barrels. Gasoline, check that out, 3.4 million versus an estimate only 500,000.
A lot of gasoline.
Yeah. And then distillates, there you go, almost 4 million barrels. The estimate was a decline of 1.2 million barrels. So oil bouncing around a bit, and like we always say when we follow these news, the first move is not always the move that carries the day. We'll see where it shakes out, but a decent move nonetheless. If you were trading volatility, you like to see a move of 50 cents, 40 cents right off the bat within a minute or two. And then, you know, if you're trading the 12 o'clocks, you have till noon. You're trading the 11 o'clocks, you have 28 minutes. And then, you know, if you are fortunate enough to get the 2:30s that line up well, you'd have all day. You'd be paying a little bit more premium. But some volatility, and it's not stopping. 63.13. We'll jump back to that market throughout the hour and see how we're doing.
Pretty cool.
Yeah. Just for a quick second, we'll jump back to oil only 5 minutes after the news came out, and already 62.82. Quite an acceleration. Move. Yeah. So again, we were at about 63.60 right before the news came out. When we started analyzing the trade, we were at about 63.75, so almost a full dollar below that level. And again, we'll check into this as the hour moves on, but pretty cool. That is some volatility, and maybe we'll be seeing some cheaper gas at the pumps. That would say
That'd be
so.
a beautiful thing.
It would,
we
for
need
sure.
it. Now I mean, the high test is now hitting 320 here in Florida.
Oh, big time, right? Yep, totally.
Yeah.
So S&P is positive by 12 points, and if we can just jump back into this oil for a moment, Tom, to check back in. So it's 10:42 right now. We're about 12 minutes past the news, and oil's not stopping. So currently 62.55, and again, that's a full dollar over where we were. And I just want to cover real quick. So when we're looking at the 12 o'clock spreads, the bearish one went from 63.75 down to 62.25. So this is where right now, you know, if you were wanted to trade out of this, you could buy that position back at 62.63. You'd be locking in about $111 of profit. That trade was going to cost you about $55 to $60 for both legs of this, okay, prior to the news. And then what you still have to consider is that, now I don't see this happening, just with the acceleration it's got, but your bullish position would still remain open. If somehow you have an hour and 17 minutes left in the expiration, and if this rose above 63.75, you'd have value. Now, I mean, even as we speak, it's not even stopping. We're at 62.42, so I wouldn't see that happening. But guess what? It doesn't cost you anything, and now even as we speak, you know, you're able to buy it about 62.50. And this is where you want to become familiar with these. You know, you can download the demo account. We've talked about it many times, because right now, oil is trading 62.43. You'd be able to buy it back at 62.50. So really, you're only buying it back at 7 pennies above where the market is. And from there, you're locking in $125 of a possible $150. You're only foregoing that last $25. And, you know, there's a lot of time left where that is quite a profitable position to consider. Do you want to risk that type of value for just the remainder of that 25 pennies when realistically, we've watched this market many times, you could see a pop, and this could pop a full 75 cents, dollar, let alone even more some days with the type of volatility you're seeing, right?
No, there's no doubt.
Welcome back, everybody. Tommy O'Brien, Dow Jones positive 252, S&P's positive by 20, excuse me, NASDAQ positive by 26. So one more check on the oil market as we come into the final 5 minutes of this hour. 62.35, quite a decline, and it is just not stopping. We'll see where that shakes out, but today's the day that volatility trade would have paid off. Nice. Yeah, for sure. And, you know, you still have an hour left, so you would have to lock in that profits, because there's nothing to say that, you know, in 25 minutes it moved down here. But, man, you know, you just back up this chart. We have seen some volatility up and down on both sides, and the number wasn't that far off in terms of the top-line number on crude from the estimate. Yet we've gotten quite a decline, and it does not seem to be stopping. 62.25 we're currently at. Now, if this expired at 62.25, that would be your max profit to the downside, because that is where your spread is. 62.25, it expires 62.25 or below. You get the full value, $150 of that. If you want to trade out of it right now, you could trade out of it and lock in about $130 of the $150, which might not be a bad trade to make with over an hour left in that. You could see a lot of that value disappear for sure.